We've all heard about growing our money while we sleep. How do people do that? Well, the answer is investing. Whether you're a beginner or you're just looking to build confidence, this video is definitely your first step into the world of smart investing. So let's break it down. First, let's discuss what is investing, because this is the first thing you should understand before you go into investing. Investing is the process of buying assets like funds, stocks, or bonds. Your goal would be to grow your wealth over time. Note, over time. Unlike saving, investing will help your money work for you by taking advantage of the market growth and compounding returns. Remember, compound interest happens over time. So you have to be patient whenever you are talking investment. Here's a big breakdown of the most common investment types. The number one, I'm sure you've heard, is stocks. When you buy shares in a company, it means you now own a small part of that company. So the thing about stocks is it has higher risk, but it's got higher potential rewards. Next is funds. Funds comes in terms of in the form of ETFs or mutual fund. Funds means a mix of different stocks or bonds, which offers diversification to reduce risk. So it means when you are investing in a fund, they will automatically diversify your investment, so that you are no longer buying a stock in just one company, but you are buying from different companies. The next thing to consider is bonds. Essentially, it is a loan that you give to a company or government, offering stable but lower returns compared to stocks. So in other words, you are giving the government or a company a loan, and then it offers you security in that the money is secure, but so there is a very low chance of you losing the money. But the thing is, it comes with a lower interest rate, so the returns are usually low. Now, to be a confident investor, you should know all these terms, and that is the essence of this channel, to make you a confident investor, a confident, wealthy individual. Okay, so when talking about investment, there are terms that you should know of. We have discussed a whole lot of them on the previous video. Please do well to have a look. If you have not subscribed to this channel yet, please, I would like you to subscribe, and you can hit the like button, and you can share with your friends and family so that they gain the knowledge, and hit the notification bell so that you will be notified whenever I upload a video. So when talking investment, you have to understand terms like security and liquidity. Now, security means how safe your investment is from losing value. For example, government bonds are secure, but stocks can be volatile, which means its price can significantly move up or down over a short period of time. Liquidity, on the other hand, means how quickly you can convert your investment into cash. So stocks are highly liquid, while real estate is less liquid. Do you get that? In other words, this means that you can easily sell your stocks to get back your cash. But real estate, for you to sell it, you have to, put it out there in the market. It could take time before you find a buyer. Now, let's understand why we should all start investing today. Investing can outperform savings accounts over time. Am I saying you should not save? Far from it. If you have watched my previous videos, you would see that I've talked about clearing your debt and how to not overpay on interest. I've talked about emergency funds, and I've talked about savings and all the different high yield savings. So as a matter of fact, before you start investing, I would advise that you have done these three things. So when we are talking about investing, so I will advise that you save as well as invest. If you put your money in a high yield savings account, then you can also, have a plan for your investment. Why should you start investing today? Investing can outperform savings accounts over time. The power of investing means your money grows faster the earlier you start. So if you start today, your money starts growing today. And I talked about the power of compound interest, which means that whatever it is you put today, in a year's time, it must have yielded some interest, and that the interest is going to yield more interest. That is what compound interest is. So the more you delay starting this process, that's not good for your wealth. So how do you start investing? The first thing to do is to open an investment account. This can be done through a brokerage, so you have to choose a brokerage. There are lots of them out there. Vanguard, Havesgrave, there are lots of them. There are also loads of apps that you can do these things with, and they've made it so simple for everyone. So yeah, we've got Moneybox, we've got Trading 212. All these apps, they've got these stocks or funds, they've got it all in the app. So it's just for you to choose where to invest your money, and it's so easy because it's easy for you to see what is happening in the account. The number 2 thing to do is to determine your risk tolerance. Are you comfortable with risk, or do you prefer stability? So if you know your risk tolerance, it will help you determine what kind of account to open. Next is to choose your investment. Are you going for bonds or for stocks? It's always advised that you mix your investments so that you will reduce your risk. Diversification, they say, always reduces risk. Then another thing I will have to mention is for you to invest regularly. Consistency is key. So it's also advisable for you to set up automatic contributions. So you can be contributing like weekly or monthly, whatever it is. But what I do not advise is for you to wait for a particular time, to invest. So now what I do is this. I set up a weekly collection by the app that I use. So as they are collecting it, I leave it in the cash ISA. So they've got this option of when they are collecting the money, you can either invest it directly, or you can let it accumulate in your cash ISA, which is still under the stocks and shares ISA. Okay. So yeah, when I do that, I allow it to accumulate under the cash under the cash part of the stocks and shares, so that by the time it accumulates maybe to a bigger amount, then I can now invest it into the stock and shares. Now the reason I do this is just so that they don't keep charging me fees, because each time you buy stocks, they have a processing or service charge. So yeah, let's assume that I want to be buying stocks each week, £100 or even £50. I don't want to be charged every week or every time I buy the stocks. So these are the things that you have to consider. As for me, I do consider all these things, because when you calculate all of these charges, you will find that they are eating deep into your own returns. So yeah, that's what I do. If you find it helpful, you may decide to do it that way. So just automate for them to be collecting the money, maybe weekly or monthly, whatever suits you best. So by the time you can let it collect for maybe 3 months or so. I normally leave it every quarterly, then I would, or every 3 months. Then I'm going to now transfer it to the stocks and shares. I'm not going to make this video long. I've divided this video into 2 just so that it's not a very long one. Now the next thing you must do after doing this is to monitor and adjust. Check in on your investment, but don't panic over short-term losses. Okay, you have to monitor, but don't panic when you think that you are losing. Now, I'm mentioning, I'll talk more on this in my next video. But why I said this is people are always quick to check if the money is growing or not. Yes, it's good for you to check that, but don't be quick to, withdraw your money when you think that it's getting low, or you think that you are losing. Okay, so always remember that when you are investing, you're not investing for the short term, you are investing for long term. And the only time you will see the returns is over time, because everything will balance out. That is where pound cost averaging comes in. Pound cost averaging means that you are reducing risk by investing consistently over time. So whatever ups and downs that may have happened, they will all be smoothed out with time. And that's a wrap for part 1. Now that you know the basics, in the next video we will dive into how to build confidence, avoid mistakes, and choose the best investment strategy for you. So don't forget to like, subscribe, and hit that notification bell to stay updated. Thank you.